Hey guys, Tom here from the Investing with Tom YouTube channel. If you're new to the channel, be sure to hit subscribe and like the video for future content. But for now, let's get into it. So today I'm going to be talking about one of the most kind of hotly debated topics in personal finance, probably in history, and that is whether or not your home that you live in is an investment. So this was probably really made famous by Robert Kiyosaki in his book Rich Dad Poor Dad, which was actually sort of the first book on personal finance and money that I ever read, to be honest. If you haven't read that before, be sure to get out there and read it. But essentially, if you're not familiar with the Rich Dad Poor Dad story, essentially Robert Kiyosaki has what he calls his sort of two dads. So he has his poor dad, who works a regular job, bought his house to live in as what he saw as an investment, and kind of worked 9 to 5 and made a living, but kind of struggled along the way, I guess. He also has his rich dad, who is actually his friend's father, who's a businessman, an investor, doesn't see his personal home as an investment. He sees it as a liability, and he goes out and invests in business and income generating real estate and those kinds of things to kind of build his wealth and snowball his wealth. So he sort of puts the personal home that you live in different categories for each of these people. So first we've got rich dad, I'm just going to call him RD, and we've got poor dad. So when you look at a balance sheet for both of these individuals, if you're not familiar with a balance sheet, essentially that's the area on typically a company's financial statements where you'll have their assets versus their liabilities. So you can work out their book value or equity or whatever you want to call it by subtracting their liabilities from their assets. So for Rich Dad, we have a box for his assets and a box for his liabilities. And assets and liabilities, and under liabilities he has his mortgage. His mortgage on his personal home that goes on the liabilities category. For poor dad we have the same thing, assets and liabilities, but for poor dad he sees his home as an asset, so we're going to put that in there as an asset. And I'm going to run you through kind of the argument from both ends, and also let you know where I fit in a minute as well. So with poor dad, essentially that represents a typical kind of middle class person, I guess. Someone that works a regular job, they go out and buy a home, they pay a mortgage for 15 or 20 or 30 years, they eventually own their home outright, and they see that as a big chunk of their success from their career and what they've got moving into retirement. But there's a couple of issues that come along with that. And we'll get into that shortly. Whereas poor dad sees the personal home as sort of a utility to them. It's just like paying your power bill or some sort of other utility bill like that. It's a means of providing shelter to yourself and your family. Financially, it's a burden. There's money going towards a mortgage every week. There's money that could otherwise be invested in business or in the stock market or in income producing real estate that is not being invested there because you've got to pay a mortgage and because you've got to put a roof over your head, basically. So that's kind of the perspective from both sides of the spectrum. And I want to run through a quick example of figuring out maybe what's the best option for you in terms of whether you should be buying a house, what is going to be the type of calculations that you're going to want to run through, and the way you're going to want to sort of look at things as well. So, if you look quite simply at whether the mortgage is cheaper than what you might pay in rent, that's probably not the best way to look at things. With paying a mortgage, you're also paying to build equity in your home, and that's not something that happens in the rental calculation. So you need to figure out how much equity is going and being built up by each kind of mortgage payment that you make. But let's run through a bit of an example. So I'm going to run through an example of some figures that you're probably going to see roughly around these numbers in somewhere like New Zealand, where I'm based. Real estate is very expensive in New Zealand. We have some of the most expensive homes in the country. And that's a big reason why I actually don't own a home, and I actually don't plan to anytime soon, but you'll see why in a sec. So I'm going to run through some numbers. So let's say that we go ahead and purchase a house and we take out a $300,000 mortgage. $300,000. So the typical payment period for this, I'm going to assume that we're paying this loan off over around 30 years. So I've got $300,000 to pay off over 30 years. And what that means is that at the end of the period, we're going to be paying a little over $600,000 in total. That's what we would have put towards the mortgage over a period of 30 years, is around $600,000 or so, assuming a 6% interest rate and regular payments of around $800 or so every fortnight. So that's option one. That's what it's going to look like if we purchase a house. We're going to be putting around $800 a fortnight towards that, and we're going to end up paying around double, or even actually slightly over double if you run this actual calculation online. Actually slightly over double what the asking price of the house was. The number that you sign on the dotted line for is actually about half of what you'll end up paying if you pay a 30-year mortgage at about a 6% interest rate. So that's option one. Let's look at option two in terms of if you'd instead put that money into the stock market and what that would look like over time. Okay, so if you buy a home like that in New Zealand, you're looking at about $647,000 if you run that actual calculation I just went through. $647,000 is the total amount that you'll pay for that house over time. And at the end, you're going to have a property that's worth probably around $600,000 as well. So if real estate prices go up around the rate of inflation, around 3% a year, that means that over a 30-year period, your home is going to double. So instead of having a $300,000 house, you're now going to have a $600,000 house, and that's kind of the assets that you're left with at that time. So you've got $600,000 in assets. You paid $647,000 for it over time, but of course you didn't pay rent for 30 years as well. So that's a positive in that example. So hopefully I'm about to run through some numbers that are going to blow your mind a little bit. I'm going to instead assume that rather than putting the $800 a week, which is what we, $800 a fortnight, towards the mortgage, we're going to put $800 a fortnight into the stock market. And the stock market in New Zealand has done around 10% a year for the last century or so. I'm going to assume about 9% for this calculation. And the other thing I'm going to do, is I'm going to put in around $75,000 up front. So in New Zealand, you need to put down at least a 20% deposit. So I'm assuming that I've done that in this example as well. So I put down $75,000, and then I also took out a $300,000 sort of mortgage as well. So let's put down $75,000 into the stock market from day one. We're then going to put in around $800 a fortnight. And let me quickly run the numbers on that, and I'll get back to you with a total answer in a sec. Okay, so compound interest is one of those things that's extremely difficult to calculate in your head for whatever reason, but I've just run that through the compound interest calculator. So if we put 75 grand in up front, $800 a fortnight after that, we end up with $3.9 million. If you don't believe me, go ahead and Google up a compound interest calculator and run that calculation. So 30 years at 9%, starting with 75 grand and putting in around $800 a fortnight, which is a little over $20,000 a year, you're going to end up with around $3.9 million at the end. Downsides to this example, you're also going to be paying rent. So you're not going to have, you're going to have some higher expenses than this example in terms of your rent, assuming we're not going to call the mortgage an expense, which I probably will. And you're also not going to have a home at the end with $600,000 that you'll own outright. So just looking quickly at these numbers, I'm going to tell you, you can pay a hell of a lot of rent with $3.9 million over your lifetime. And 3.9 million is a hell of a lot bigger number than 600,000. So although there's some advantages to owning a home in terms of security, not having to put up with landlords, knowing what your expenses are going to be with your repayments, assuming that you've locked in an interest rate. There are some advantages to this, but there's definitely some big disadvantages. You can't, if you get to retirement and all you have is a home and maybe a few $100,000 in a retirement account, you can't go down to the shop and spend home equity. If you have a freehold house, that's not of any kind of immediate liquid value to you. You can't go down and spend a few $100s from your home equity. If you want to make use of that, you're going to have to downsize your home, live in a smaller house, and kind of spend the difference from that downgrade amount. Whereas if you've got $3.9 million in the stock market, that's going to be throwing off a huge amount of income and dividends. If you've got $3.9 million in rental properties, it's going to be throwing off a huge amount of cash flow from rental income. And if you've got $3.9 million worth of private businesses, that's probably going to be throwing off a hell of a lot of cash flow for you as well. And if you want to actually get a whole bunch of cash with you at once, you can very quickly sell off a portion of that $3.9 million quite quickly. If you really wanted to, in the stock market, you can sell $4 million worth of investments in the stock market in probably 10 minutes. That's how liquid the stock market is. And it's how easily you can get cash coming towards you. It may take a day or two for that cash to settle and turn up into your account, but it's a hell of a lot more liquid than a $600,000 house. And hell, if you've got $4 million and you're wanting to retire, you can go buy a $2 million house or something. Just pay cash for it, you'll be good to go. I'm sure we can all live quite comfortably in a couple of $1 million house. So that's sort of my opinion on the big debate of whether or not you should be buying a home. I think that a mortgage payment is a massive liability. It's a utility, it's a place for you to live, that's what you're paying for. In my opinion, it's not an investment. There's much better investment vehicles out there than buying a home to live in. A home to live in is not going to throw cash back at you just for living in it. You're going to save a bit on rent and you're going to build some equity in the home, but there's some big downsides of that. You can't spend that equity, and you've kind of put yourself a few steps back in terms of being able to put cash towards other things. So if you're being weighed down by an $800 a fortnight mortgage payment, you can't put huge amounts of money into the stock market. You can't go out and buy a business that might come up. You can't buy a farm that might come up. You can't do all of these really cool things that can potentially generate a lot higher returns. So that's my 2 cents. Let me know your thoughts below as well, and if you enjoyed the video, be sure to drop it a like and hit subscribe. This is a pretty hotly debated topic, as I say, so I'm pretty keen to hear your opinions in the comments below. But that's all from me today, and I will see you in the next one. Cheers.